Eugen Weinberg, head of commodity research at Commerzbank. And Eugen, just looking at gold prices, they're falling back about 4% over the past month, despite being higher if you compare them to the start of the year. Why? I mean, what are the driving factors behind gold prices right now? I mean, of course, we've had the Fed signaling that they're going to hold back on more stimulus. If we do get the U.S. economy maintaining the momentum that we've had thus far, is that a bad thing for gold?
Good morning, Maryam. Probably yes, and for me as a structural gold bull, it's very difficult to find myself right now in a tactical camp of gold bears, but I do believe that the prices are likely to dip probably between April and June, July this year before they will recover by the year end. And the reasons for the dip are pretty obvious right now. We've got probably already some reports that the Q3 is becoming less and less likely. At the beginning of the year, it was very likely that we would have it by probably the summer. And also the economy is recovering, which is bad for gold, not as a commodity, but as a safe haven. So the less demand for safety, and the dollar is also recovering, which is also another negative factor for currency gold. So I think that the momentum, the short-term momentum, is likely to stay negative, and we are likely to see the prices below 1600, although I'm staying bullish on the longer term and believe that the negative real interest rates, that the inflation fears and the longer-term concerns about the economy are likely to keep the prices and they're likely to keep the long-term trend intact, and the prices are likely to reach another all-time high by the year end.
Yes, I mean, given that you're, as you say, you're a structural gold bull, you're positive on long-term prices, does that mean that the dip over the next few months could present a good buying opportunity?
It is definitely a good buying opportunity, but at the moment the optimism, the market is probably overly optimistic. It has been in this situation since last summer, and right now the disappointment of the gold bulls is you can actually feel it, because all the other commodities like copper, oil or even grains powering up since the beginning of the year, and the gold price is struggling because gold is actually not a commodity. It's a currency, it's insurance, but by no means it's a commodity. So yeah, this disappointment is likely to present a buying opportunity in the coming months.
Copper has been rising for the first time in 3 days. Anticipation here that the central bank in China will ease monetary policy. What are your thoughts on this, Eugen? I mean, do you think we're likely to see China either cut rates or indeed reserve requirement ratios in April? And is that going to support copper prices?
We shouldn't be forgetting that China is going into the transition year with Prime Minister Wen and the President Hu going to give the power to their successors this year. So we are likely not to see any major surprises, whether to the downside, not to the upside this year. So unlikely to see any disturbances, but the growth of 10% as we were accustomed over the last decades, it's likely also to be a thing of the past, at least for this year. So the momentum is still strong, and China, in contrast to most other economies, is having lots of room for easing, for monetary easing, for new economic programs. But we are probably going to be continuing a moderate pace of the gains, and likely to see the Chinese economy powering up again only next year.
Okay, so copper price is likely to moderate this year, as you say, before picking up in 2013. What about oil? We're seeing prices rebounding from a 7-week low. Are supply concerns still impacting those prices?
Yeah, oil is not being driven by the demand right now. It's being more driven by the supply concerns in the US as well as in Europe. The Brent prices are probably being biased up upwards by the concerns around Iran, and on the other hand, WTI is being biased down to the downside by the current shale oil production and very high imports, which increased only over the last 2 weeks by 1.5 million barrels per day. So in effect, it's a combination of both, and it's likely that this price difference is likely to stay high for the foreseeable time. And it's so much about supply. It has little to do with the overall economy. At the current levels, I think Brent is likely, the current prices of Brent are likely to weigh on sentiment on the worldwide economy, so it's likely to diminish probably the demand growth worldwide.
All right, supply side concerns driving oil prices. Mr. Eugen Weinberg, head of commodity research, Commerzbank. Thanks for your time.